Be fearful. There's panic. There's uncertainty. There's volatility. The stock market's going crazy. News keeps hitting the tape like we're getting socked from a left hook to a right hook to an undercut. I don't know if those are accurate terms for boxing. I'm not a boxer myself. I stare at computer screens all day. You're watching the Stock Market Brief Show. My name is Michael Silva. You're watching a weekly recap. We got timestamps in the description. If you're new here, well, first and foremost, welcome. We use technical analysis, intermarket analysis to get a good idea as to where the market might be headed next. Look, I'm dropping this video today, just so you know. Tomorrow I'll be dropping another video. I'm going to be just talking more specifically around crypto. I'm not going to add that in today's video just because of a length issue. And then the following day, I believe Monday, I'll be dropping the interview that I had with David Garofalo. We got a lot to talk about in today's episode. Let's get into it. Welcome back, everybody. How we doing for 2022 so far? Not so well. The Dow Jones down 6.2% year to date. S&P 8.7% down. Nasdaq 13.4%. Russell 2000 is down 10.54%. Got the little guy with the palm on his head. Is it time to buy now? I don't know. You know the saying, right? Be greedy when others are fearful. Be fearful when others are greedy. It's a difficult time to decide that right now. Here's an interesting chart. I'm looking at the S&P 500 on a quarterly time frame. Okay? And I'm showing you this because I showed it on the quarter close of last quarter. Or a little bit before that. Maybe it was like the yearly open. I can't remember when I showed the chart. But the reason why I showed this chart was I was looking for a reconnect of the 5-period EMA on the quarterly chart. And early in the month, I think it was January 24th was the date, we tagged that. Last month, sorry. And I just wanted to call this out because I don't think I've heard anybody talk about this. But do you know where that level actually stands? Yes, it was in correction territory. Here's bear market territory. But that level right there that we tagged was the 50% retracement of last year's low to high point. So in just a month's time, because it was January 24th where we hit this 50%, less than a month, we wiped out from peak to trough, right? We came all the way back down 50% of the previous year. Previous year was great. Now, why am I calling this out? Because a lot of people are calling for a potential bear market. Now, if we go to bear market territory, which is way down here around 3,900, where does that put us in comparison to the previous year? Shoot, that's a ways down. Right when we tag into bear market territory, if we were to get there, that wipes out all of last year's gains other than just 2.6%. It's pretty crazy. It's pretty crazy to think like that because that was such a powerful year in the S&P 500. Let's move on. Wilshire 5000 composite. We talked about this in the prior week, and we did break down from this bear flag. PPO is starting to curl over here, and it doesn't look good. It's so like I stated in the last episode or the last weekly recap. It's so obvious. We had a double top. There was a negative divergence. We broke down from a channel. We came out. We goes below that 200-day moving average. We back tested it. RSI couldn't get back above the 50 marker, and then we started heading lower. It's not looking good. It's just not. And if you're wondering why I'm using the 5,000 composite index, the Wilshire, it's because this is a composite of America stocks. Okay, so everything basically compiled into it for the most part. All right, so when you look at the broad index and it's looking weak, we're below the 200-day. I mean, and we're seeing the volatility, right? You got to be careful. We've been talking about this. It's nothing new. In the news, there's actually been significant intelligence that dropped today that maybe most people haven't heard. And there is a very, very bearish dog in my backyard staring at the sprinklers just as much as I stare at my computer screens. Moving on, Fed Bullard. So we had a lot of news drop this week. Fed Bullard says that inflation could get out of control, so action is needed now. Not too much different. We've been talking about this, but we have just Fed speakers hidden left and right. We have economic drops as well. The other Fed says it's appropriate to start a series of Fed rate hikes in March. Well, of course so. We've been talking about that. We've been seeing that. Biden came out, right? And citing that U.S. intelligence, Putin has decided to invade Ukraine. It hasn't been done so far, and apparently there's going to be a conversation apparently held. They have till the 24th is when they decided to put that together. But he did come out with a press conference, and he said that he seems convinced that this is going to take place. And I really hope that that is not the case, because they could say they could go into the Capitol, which there's 2.5 million people if I remember correctly. So the market's uncertain. All right, we'll talk about it. Fed approves rules for banning its officials from trading stocks. That was also in the news. Wow, really? Let's just take a look at this chart. They approved that, and this is where they were all getting out, and when all the controversy around Fed officials were talking about their positions, and then they started leaving the Fed right here at the top. So you have Fed officials dropping off, you have all these news bombs, you got all kinds of crazy things happen. You got Kathy out in full force talking on CNBC, I think it was, that it's a deep value fund, the ARK fund. And maybe she's right, maybe she's not. To me, it sounds crazy right now, which is also a potential reason to, if everyone's thinking that she's crazy. First off, this is funny actually when you think about it. Everyone was praising her all the way up to the highs. All right, and that was probably the worst time to get in, when everyone was just praise. Now everyone's starting to wake up and be like, nah, this is garbage, and everyone's going to look at it like garbage, and that might be the time to start like, maybe it could be a time to start accumulating. But when you look at the chart, it's down around 60% from its all-time high. It looks like crud, to say the least. Rapid inflation stokes unease from Wall Street to Washington. So we have CPI stuff. Right, high inflation. So what I'm getting at right here, right, there's a lot of news. What does it all mean? It means I am once again asking for you to like and subscribe to my channel if you haven't done so already. It's greatly appreciated. More volatility, more uncertainty, more noise. When we have a lot of things taking place and being thrown left and right, you are going to see more volatility, more uncertainty, and more noise. More noise is created from this because you're going to have a lot of people giving their narrative, throwing left and right. We're risk on, we're risk off, we're this, we're that. But really, it all boils down to uncertainty. And, people start to look, and this is where it gets very interesting, is people look for confidence in these type of times. Who is the most confident that something's going to happen, right? So if you take a turn to the left and you see David Hunter, he's talking about a melt up. He's certain that it's going to be taking place. Right? And people find comfort in that certainty. But let me just tell you this, and there's other people that are certain that the market's going to collapse, right? When you have all this noise and all this uncertainty, it's very natural to go to somebody that is extremely certain. But just understand, it is an uncertain environment. There is more volatility. There is more noise. No one actually knows what will be taking place at this particular point in time. And you can tell that specifically in the markets by the amount of volatility that we're seeing. Let's hop into the S&P 500 weekly chart. Down 1.41% for the week. We are below these key moving averages. I want to point something interesting out. First and foremost, we need to look at a wider chart dating back. So weekly time frame, and I'm specifically looking at a couple moving averages, the 5 and the 30 week. Okay? So, and I have these blue arrows on the screen. So first, what I found interesting was we got below the 30-week moving average, okay? And we're right there, right below that, or right at about that lower Bollinger Band. Okay, so that's one interesting thing. RSI, below 50, pointing down. That's another interesting thing. PMO, pretty nice spread between these two lines, and also pointing down, okay? Another thing to call out. If you look back to 2018, this seems very, very similar. First and foremost, RSI. Actually, let's look at price action first. We have a declining 5-week moving average. We came back, we back tested the 30-week moving average, right? We came down, we back tested into a declining 5-day moving average, and got rejected by the 30-week, very similar. And what was the RSI doing at that time? We came back, we back tested it, and we started heading lower. We back tested it, we started heading lower. Nice spread on the PMO2 as well. This is looking very similar to what we saw actually in 2018. So it doesn't mean it's going to have the same outcome and continue to take out this low. It's a possibility, but why I'm calling this out is because during 2018, we did see more volatility. We actually saw it spike back up, give some more confidence, and then continue to sell off too as well. So if we see something like that, boom, we can move back up, but that doesn't take us out of the, out of the woods or whatever the saying is. We can very well go back up and back test this 30-week moving average, create another top right here, maybe back test the 50 period on the RSI, keep focus on that PMO, right, on the weekly time frame. It's still pointing pretty much vertically down. So yeah, there's a possibility that more volatility could come into this, especially if we have some more geopolitical risks that continue to elevate here. All right, if we take a look at the daily time frame, I like to use these risk ranges. The risk ranges give us a good estimate. It's what the options market is pricing in as far as volatility goes and where they're basically might close within the week. Now, last week, it was a large range of volatility, right? From 455 to 427, the light dashed gray lines. And we closed just beneath the middle portion of that. So it was accurate, right? The Theo team did a study where they said 68% of the time, the options market or the price action will finish within the options market's predicted price range. Now, what are they pricing in this next week? And next week, mind you, it is a shortened holiday week. All right, we're no trading on Monday. And there's still a lot of volatility. It's still a wide range. 12.24, 12.25, we'll just call it on the SPY. So plus or minus. So what does that look like? It has a move to potentially up to 447.50 on the upper risk range. And then on the lower portion, it's 422.50, which could go retest this January low. A lot of people are saying that was the low. The low's in. Now we're going to be moving up. Okay, that's a strong possibility. If we get a very quick hit to the downside, I'd be actually interested in playing a bounce, but it has to happen, within the first trading day or so, if that's actually the case, because I want to see a very strong move, right, to the downside to play some sort of intraday bounce or maybe potentially put on a position. But overall, we're below these key moving averages, so be very careful. We want to recapture those, all right? There's a lot of pressure to the downside, and we're going to get into some S&P 500 sectors momentarily, but understand this too. Tech has been getting hit hard. Consumer discretionaries has been getting hit hard. Financials is a big weight in the S&P 500, and they haven't really given way. They're actually positive year to date to relatively flat. If financials back off because the 10-year yield might back off, or the 30-year yield or yields back off, that could produce more downside in the S&P 500. If we take a look at the 15-minute time frame, still beneath that declining 5-day moving average, we still have a positive divergence building on both the PMO and the RSI there too as well. But just take note where we are. We're just chopping back and forth at this particular time, looking for some sort of setup to take place. Now, we've been looking at the volatility index, the VIX, the fear index, and it's starting to head higher, right? We have a couple gaps beneath us. I found something interesting, and I want to call out one more time because you can see this as a potential inverse head and shoulder forming. And the reason why I'm showing you that potential inverse head and shoulder is because we talked about that here as well on this inverse head and shoulders. And we said prior to even getting up here, way before that, that would bring a target to around this range. And sure enough, we came out, we back tested, and we ripped higher. And I just want to call out, oh my goodness, if this is actually another inverse head and shoulders, right, that's forming, and we break out, we back test, and we shoot up higher, there's one gap above us at 45 that right here on a full measured move would definitely go attack that specific level. If we take a look at this is the tips over treasury bonds, and I like to apply a 10-period rate of change to this because for some reason when it gets to around 1.4 to 1.5, you can see these vertical lines or these pink circles right here. When it gets there, it's like almost a leading indicator to seeing some potential volatility spikes. And the most recent were these two hits right here, and bam, you can see that volatility spike here. Same thing, boom, here a little one, here little one, here boom, and boom right there too as well. So it's been a reliable tool, especially on these last few triggers. I don't know how long this is going to be holding, but I just want to call out that this is pointing up. It's not quite there yet, but if it does get up there, interesting. It could be giving us an early indication that there could be more volatility come. If we take a look at the BP chart still shows room to go lower. Okay, and that would be that oversold condition where we can start looking for bounces. It also has the potential to go higher. It is below 50 here, and it's below 50 on the BP-SPX chart too, which is not always that great of a reading. Mind you, we are getting some oversold conditions based off of all these geopolitical risks, so things can happen very quickly, right? We're getting sloshed back and forth right now. Nasdaq 100, let's hop into the weekly time frame. Clearly, the cues are weaker than the S&P 500 because financials is really holding things together quite well. well below these key moving averages. PMO also pretty darn bearish. If we take a look at the daily time frame here, plus or minus 12.83 point move. Also, a lot of volatility coming into a weekend that's shortened trading week. Now, if you take a look at the last week's range, it was very large, right? Just above 360 to just below 335. We closed right within it. Go figure. Now we have another big range of volatility here saying that we could potentially take out this low. Now that is interesting to me because if we do get continued weakness and we take out this low early in the trading week, I would also be considering potentially hopping into a position, either, a very short-term position and managing the risk closely. But I might not just do it when it comes down there or lower. But if you can undercut this low and come back up, that could be, it could be, triggering some stops, getting some people out of their positions, and then you might see some sort of a rally or relief move. So that is something that I want to pay close attention to. But you never know. We could just very well just bounce straight up here to around 355 and just be mindful that if we get an overextended move to the upside very quickly and we're below these key moving averages and there's already a lot of volatility, I'd also be looking for a potential short position there. That's how I'm kind of going into it next week. If we take a look at the cues on the 15-minute time frame, look at positive divergence here, positive divergence there, but we're right beneath a declining 5-day moving average. We have a volume shelf profile right here, and that's right at about that gap fill. So if we do move up higher, we're in confluence with the volume shelf profile for resistance. We're in confluence with the gap fill that can act as resistance, and then we're in confluence with the upper risk range right here too as well. So if we do get a quick snap move up here, I would say that might be a potential area to potentially short. Now, it depends how we get there and what is the news that helps push us up into that direction. So just be mindful. You always have to just manage that risk closely. If we take a look at the BPNDX chart, if we get hit to the downside, this is going to get extended to below that minus 30 reading, and that could be a potentially good opportunity to start looking for that long position. So this is a signal chart I like to use. Look at it, got overextended right here, tapped it, and then we started coming off in the Nasdaq 100 or the Qs. We had the bullish divergence, right? We talked about that, and then we got that bounce up too. So I like to look at this for either overextended to the upside, downside, or bullish or negative divergences. If we take a look at the Russell 2000, not looking all too hot. It was an inside trading week. PMO is still trending down. So we'll see here. If we take out the low, right, of this previous week right here, that can, signal some more downside. It does look like it's forming somewhat of a bear flag at this particular point in time. If we look at the daily time frame, volatility, it's basically saying we have a risk range of around 207.50 to the upside, which comes right into confluence of this previous two areas of resistance, and then to the downside to around 192.50. So if we get to either of these levels earlier in the trading week, it might be something to pay attention to as far as a potential trade setup goes. This is one of the more bearish indices of them all. Let's hop into some sector analysis. So let's look at the week-to-date performance for the 11 sectors that make up the S&P 500. Consumer staples led the way. It was up 1%. Consumer staples is more defensive. Down there towards the bottom, energy come off a little bit. Okay, that's interesting. And then where did XLK finish? XLK was more middle of the pack. What I find interesting in all of this right now is everything was red on the week except for consumer staples. So definitely some defensive posturing taking place. If we take a look at year-to-date performance, energy, financials lead the way. So if you're looking for something to potentially get hit if we get some more downside, like I've already stated, financials is a big weight. And if the yield, the bond market, right, if yields come off, what has been driving the financials? Well, we've been seeing a rapid move in the 10-year yield, these long-dated yields, and that's been really benefiting both financials and energy, actually. If you look at a chart of the relative strength line between energy and the SPY, and you compare that to the 10-year yield, they almost move hand in hand. So if the 10-year yield backs off, right, and bonds get bid up, guess what? Energy might take a little bit of a breather, which we saw this last week, right? And financials might back off too, which we saw last week. Financials was one of the worst performing sectors along with energy. What happened? Well, yields backed off, bonds, they went up, which is interesting because typically the bonds and stocks have the very similar correlation, and they have been, but when you look for this flight to safety, guess what? That's kind of diverged a little bit here in this previous week. Let's take a look at a rotation graph. Relative rotation graph, consumer staples still wiggling its way into that leading corner quadrant. XLE is very strong on the weekly the 4-week tail length right into that leading category. So if you're looking for energy trades, XLE is still very strong and it's still trending, right? So there's still possibilities, still great, opportunities within that. It might be a little extended. It could be backing off, but it's still overall a leader. Financials is also a leader, but it has been coming off there slightly too. XLU is kind of turning back down, but it is still in that leading quadrant along with healthcare, materials, and real estate there. The two big ones, XLK and XLY, are still turning in, right? And XLY is in that lagging quadrant. XLK looks like it's pointing down there. And those are some big weights, obviously, in the S&P 500. Let's look at a couple of charts of the sector. So first and foremost, XLP, strong relative strength line here between the XLP and the S&P 500. I like this. I'm looking for them to, get more, tighten up a little bit here. There's still quite a bit of volatility. I still think that this is going to be a very strong player. So I have been holding positions in XLP. I've been in and out of certain positions in consumer staples. I would like to see this obviously break out and get back above that 77, and I think it has some room to go if this more defensive posturing continues to take place. If we take a look at financials, last time I brought this chart up was basically when it tapped this red line right here, and we did crack down through this rising wedge, and we're starting to head lower. We're back below these key moving averages. So if the SPY is going to continue to sell off, I would expect there's more downside here in financials. That would lead that S&P 500 down potentially more here, and that could come to around 38, maybe retest that 200-day moving average, and then we can look at this as a potential channel that is just with trading within. So that is one to watch. If you're looking at specific names within the financial industry, if you're looking to potentially short, look at some of the big names, right? Things that have been overextended. I know that American Express has been holding up very well, and that thing is just, it looks very extended from just an absolute perspective. So that could be potentially one to watch. You could also look into bigger names like Wells Fargo. XLE has broken down from this rising wedge, but it's really just consolidating. So this still to me looks pretty strong. I think if we start taking out this low right here at 67, closing below that, then we might see some more downside where you'd really want to pay close attention to that 50-day moving average, because that could act as an area of support, and that would be a potential good area to look long to as well. But if we come off a little bit more, I would even look at around 67 to 66 as a potential position to potentially bounce back up within. If we take a look at utilities has been channel bound, up, down, up, down, up, down. And I just wanted to call out, we're right there at that 200-day moving average. Seems like we have some defensive posturing taking place. We have a relative strength line kind of turning up here slightly. This may be an opportunity to potentially play it back into the middle of the range to even the higher portion of the range. Notice just how the middle of the range has been acting as an area of resistance and support back to resistance. So if this wants to hold within this channel, that could be a trade from around where we're at 66 to around maybe potentially 69. We just need to get back below these, back above these key moving averages, right? We're below a declining 20-day and a flattening 50-day moving average. XLI, it's been sideways trading. We're dangerously close to breaking down from 97 and 98, this little zone of support. So if you're looking at, hey, this might catch a bounce here, you can potentially play it into the middle channel, 102, or even higher. Just be mindful that it's below declining moving averages and a flattening 200-day. If we take a look at XLV, it's well below that 200-day moving average right here too as well. Potentially, if we get some more weakness, you can look at around 125 for an area of support, and then you can play it back up into potentially the 200-day moving average, which is right around 130. Going forward, if we take a look at XLK is looking pretty darn weak right here, back below that 200-day moving average. It's been going hard and fast to the downside, so I can see potential for a bounce here, but I just don't see a specific trade setup at this particular point in time for XLK. Now, if we start ripping higher, there could be potential short opportunities, but it's just not there yet. If we take a look at XLY, we did break down from that bear flag, starting to head a little bit lower, back below the 200-day, back below the 20-day moving average there too as well. I don't really see a great setup here at this particular point in time, so I want to let more time go by before looking for something here with X. Now let's hop into bonds and yields. If we take a look at the TLT was down slightly on the week, but it did put in a nice hammer candle where we did catch a nice bid as the market continued to see a lot more weakness. If you take a look at the TLT on the daily time frame, where we're talking about this wedge, and we started breaking out to where, well, that next area of resistance which I was paying attention to. If we start getting above that, there's not too much much volume within this range, which opens the door to quickly move to around 141 to 142. So we will see here if there's more upside in TLT. Meanwhile, the Treasury yields continue to just really flatten out here. You can see the 10 and 2, we saw a little bit of a move up, but it continued to flatten out here. The 35, same thing, starting to flatten out here again too. Never good. These are great recession indicators. It gives us warning, and you can just see here in 2022, if you just draw from these yields from up here to down here, you can just see this expansion, and it's been tightly contracting and contracting, meaning that the yields are flattening out. They're not widening, and that is not a good sign. We will see here, I know here in March coming up, what the Fed does, and I'm assuming that whatever it is that they do, there is going to be a significant move in these curves. Let's take a quick look at the dollar. The dollar is still holding up quite well. I wanted to draw out this trend line because this trend line's been holding, right? Higher highs, higher lows. It's relatively going sideways. The dollar saw some strength in the last trading day, and it looks like it could potentially have the power to move higher. And if that's the case, if it moves higher, that can drag those S&P 500s down as well. And we've seen this correlation take place where we saw this rapid move into the dollar, right? This rapid move of change. And guess what? S&P 500 sold off. But when it came off hard and fast, guess what? S&P 500 rallied really hard. Now we're starting to see it move up. And now we're starting to see this sell off here. So I'm thinking that, hey, if we start cracking down through this trend line and start heading lower, that could signify that the S&P 500 has some legs to it, could potentially head higher from here. So that's going to be an important one to watch. All right, everybody, we talked a lot in today's episode. We went over the risk ranges. We went over a bunch of news headlines. Understand pretty much the most important slide here was just be aware of the market conditions, right? There's a lot of noise out there. There's a lot of uncertainty, and when things are uncertain, people look for certainty, which creates just a massive amounts of volatility here too, being thrown around with these news headlines. So you got to be very, very careful in this environment. As we stated in these sectors, XLP is a more defensive name, and that has been creeping up on the leaderboard. So if that is the case, risk off is continuing to build. But right now, it's just been this light switch between risk on, risk off. Are we risk on? Are we risk off? Okay, there's a bunch of indicators saying that we could be risk off. There's a bunch that are saying, nope, we're still risk on. That is the uncertainty that I'm talking about. And in times of uncertainty, make sure you're paying the most attention to risk. Well, that's all I got for you on today's episode, everybody. See you later.